I'm Emily Costa, and this is the Commodities Institute podcast. Today is December 2nd, 2025. Thanks for joining me. Pull up a chair, pour yourself a coffee, and let's walk through what's moving markets right now and why it matters to producers, traders, and consumers. We start with oil, because a single strike at sea can ripple across continents. Late last month, a major drone strike hit the Caspian Pipeline Consortium's Black Sea export terminal. Operations at one of the terminal's single-point moorings were heavily damaged, forcing a temporary halt to loadings. The consortium has now resumed shipments from the other mooring, but this is not the same as full capacity. To put it plainly, CPC handles roughly more than 1% of global oil flows and about 80% of Kazakhstan's overseas exports. When one mooring is out and another is under repair, flows into the global market shrink quickly. That tightening forced some shippers to reduce intake from producers by up to 40%, and storage at the terminal is limited to only a couple of days before output must be curtailed. What's important here is not only the immediate volume impact, but the vulnerability it exposes. These offshore moorings sit several kilometres from shore and tie back to onshore pipelines. They were designed for steady, reliable flow, not for military-grade disruption. The consortium has said replacement moorings are on the way next year, but in the near term expect volatility in crude differentials for Black Sea grades and for refiners that depend on that supply chain to reprice barrels or seek replacements. That in turn feeds into broader pricing dynamics, especially in Europe and the Mediterranean. Linked to that is a geopolitical subplot. Russia's president travelled to India this week with a push to deepen energy and defence ties. For Moscow, India remains a critical customer and potential source of equipment and spare parts, even as sanctions complicate normal commercial channels. For New Delhi, the calculus is balancing energy security, defence needs, and the risk of friction with other trading partners. The trip could nudge some flows and influence where Russian barrels ultimately flow, but it's the more immediate Black Sea disruption that is likely to shape markets in the coming weeks. Shifting now to gas and power, US liquefied natural gas exports hit a record monthly high in November, and for the second month running. Cooler weather along the Gulf Coast helped plant performance, and the major exporters pushed more cargoes into the Atlantic basin. Europe remains the dominant destination, taking roughly 70% of US shipments last month as the continent continues to replace pipeline volumes. That pattern underpins European energy security through winter, but it also amplifies competition for flexible cargoes and keeps prices sensitive to weather and logistics. Meanwhile, Asia's demand picture is less robust. China's LNG imports have softened this year and may be close to losing its crown as the world's top LNG buyer to Japan. Elevated spot prices, routinely above 10 million British thermal units for much of the year, are a key reason. At those price levels, spot cargoes look expensive relative to local alternatives, and buyers take only contracted volumes. So while US exporters chase arbitrage opportunities, the ultimate flows depend on where buyers are willing to pay up. Let's pivot to metals, because a pair of strategic stories are quietly reshaping supply-side dynamics. First, in the miners' world, Barrick Gold is evaluating an initial public offering of a vehicle that would house its North American assets, including its stake in the massive Nevada Gold Complex. The logic is clear: package up the high-quality, lower-risk assets and give investors a pure play on those ounces. If executed, it could unlock significant market value and concentrate riskier African assets elsewhere in the parent company. Second, China has moved to streamline rare earth export licenses with new general licenses that speed shipments for certain magnet makers. That's a technical tweak with outsized consequences. Rare earths are the backbone of permanent magnets used in wind turbines, electric vehicles, and advanced electronics. Any easing of export friction can ease supply constraints for international manufacturers that have been navigating a patchwork of approvals and political tensions. For buyers and industrial planners, this is the kind of policy change that can change project timelines and cost assumptions overnight. On the industrial side of metals, Japan's biggest steelmaker has also been in the headlines after closing its acquisition of a US steel group. The new owner expects a temporary dip in the US unit's performance, but is committing large capital to upgrade plants and reduce variable costs. That's important because global steel availability and cost feed directly into construction, machinery, and energy projects. When capital is earmarked for modernization, the medium-term effect is usually positive, but the short-term turbulence can be material for regional spreads. Turning to agriculture, Ukraine's first official estimate for the 2026 wheat crop points toward a pickup in production, a rise to somewhere between 24 million and 25 million tons from about 23 million last year. Ukraine's winter wheat acreage was reported as largely complete, and these planting dynamics matter for global markets because Ukraine remains a major supplier to Europe and beyond. At the same time, Spain is scrambling to contain an African swine fever outbreak detected in wild boar near Barcelona. Though the disease is not a human health risk, it spreads quickly through pig populations and could constrain pork exports from a country that is one of the world's leading suppliers. Spain already saw some export certificates blocked and has moved to isolate an affected zone and deploy emergency teams and drones to remove infected animals. The risk here is economic. Localized outbreaks can reverberate down the value chain from farmers to processors to buyers in Asia that rely on Spanish supply. And adding one more agricultural note, Algeria has put out a tender for soft milling wheat for shipment in early 2026, a reminder that buying patterns and tenders from big importers can swing demand in specific months and lift nearby freight and storage markets. Speaking of freight, the dry bulk and tanker markets are watching these agricultural and energy moves closely. Reduced loadings at a major Black Sea terminal mean not only fewer barrels in port, but also fewer vessels needed, which tightens the available shipping pool in other geographies and can push day rates up for certain routes. Freight is the connective tissue. It amplifies regional bottlenecks into global price signals. So what do we take away from this mix of stories? First, supply chains remain exposed, whether it's a mooring struck at sea, a virus in wild boar, or an export licensing rule change. Relatively small, localized events can have outsized ripple effects when markets are already tight. Second, the geography of demand matters. Europe's need for LNG continues to underpin Atlantic flows, but Chinese pricing sensitivity means Asian demand can be swingy. Third, policy and corporate action, from reorganizing mining assets to streamlining export licenses, can shift market structure fast, and traders should never be complacent about the length of lead times for changes to translate into real supply. As we head into the close, a practical thought for listeners. Watch the Black Sea loadings closely, follow LNG cargo tracking for where US volumes land, and keep an eye on export certificates and health reports from major agricultural exporters. Those will be the early warning signals that tell you whether a short-term disruption becomes something more structural. That's it for today's conversation. I'm Emily Costa. If you found this episode valuable, be sure to subscribe, share, and leave a review.